Alright, let's continue with this video since we're on a roll here. So we started with this slide as our lead in on part one. Price of gold, $2,500 an ounce or better by January 2023. In reality, I don't think that's it's not really all that bold of a prediction. But anyway, so in part one where we ended, we were finishing up with the fact that in the big bull move from 2002 to 2012 started back here in early 2002 with a moving average crossover. The 10 period moving average crossed above the 40, and that marked the start of a 10-year, and actually it's 11 years before the fast moving average crossed back below the slow moving average. But that's a pretty significant signal with that moving average there. Now, we did get a pullback all the way to the 40 period moving average. And of course, if you just happen to be ready at that point in the financial markets, hey, that's all well and good. That was a good buy point, obviously. But we're talking here about the signal, this moving average crossover. And so notice, and the point that I want to make here is that, look at this, the fast moving average has clearly crossed above the slow moving average in a decisive manner. And potentially that crossover is marking the start of another 10 or 11-year period. And of course, that is consistent with my belief that the precious metals are currently in a secular bull market that will run for the next 4 years at a minimum, and quite likely the next 8 to 10 years. There's a period in here, we had what seemed quite substantial at the time. In 2016, we got this rally in gold, and of course got this price, the crossover in the moving averages. Well, price didn't really do anything in this monthly time frame for the next several years, just kind of waffled sideways. So what I want to point out is the difference between this moving average crossover that occurred in late 2016, mid 2016, versus the current one. I mean, it's night and day. And so anyway, that, in my opinion, is a significant indicator. That moving average crossover. Let's see, what did we want? A MACD. All right, let's throw MACD onto this chart just for funsies. And so a couple of things I like to talk about, or not just talk about, look at for MACD when I'm looking at a chart. So first thing is that both lines, whether we want to talk about the MACD line or the MACD signal line, both lines are above the zero level of the indicator. And so the way I interpret MACD, that tells me that the primary price trend is up. And so I use MACD as a trend indicator. Price trend is up based on MACD. Then, of course, we have the MACD buy signal. When the signal line crosses above the MACD line, that occurred way back in, what is that, May? Yeah, May of 19. And so we're still on that buy signal. The MACD histogram is telling us that momentum is strong, not only strong, but strengthening this month over last month. That's just real bullish. The other thing that I like to look at in MACD is not a bounded indicator, but the previous highs and lows tend to act as not necessarily the limiters, that's not the right word, but resistance levels. And so, for example, in this case, when MACD gets up to this level, I might expect to see price struggling, needing to consolidate, maybe waffle sideways for a while. But anyway, price has plenty of room. MACD has plenty of room before it reaches the level of overboughtness way up here that it reached back in the previous rally. And so let's see, MACD, that's it for MACD. Let's take that off the chart. And one more indicator, stochastics. And so the way I read stochastics, it's price energy. It's, is the gas tank full or is the gas tank empty? Up here the gas tank is full, down here the gas tank is empty. And so all I really care about in stochastics is that energy level is high, which of course in this case it obviously is. And what that tells me is that if price wants to go higher from here, it has the energy to do so. The tank is full. And so that's all we needed to look at in stochastics. And really, folks, that's all I've got. Well, no, that's not true. There's one thing I've yet to share. Do that right quick. So one of the advanced techniques that Tim Morge teaches, and I just encourage you folks, if you're looking for education and it works for you, go get educated by Tim Morge. He's a consummate educator. Won't be sorry you did. So anyway, this gets us back to how did I arrive at this first chart that we looked at. And so Tim Morge refers to it as crayon drawing. And if you saw, all I did is take a trend line and I drew it from the start of this price movement up to the median line right there. I take that line, I copy it, I clone it, copy it, whatever, and then I throw it up onto the other side of this movement. In this case, it happens to be it's this horizontal. We don't know that it's support yet because support is untested. We know that it served as resistance back here in the 2012 rally. Hard to argue, didn't really serve as resistance. The recent move, price sliced right through that level like it was butter. But so anyway, we draw this trend line from the start of the price move to the end of the price move. We duplicate the line. We move it up here to where we expect the move to resume. What I am assuming is that price is going to, from where it is, at some point we're going to get a pullback. And so we'll get a pullback and price is going to pull back and test what used to be resistance. Price is going to test it for support. Assuming that price finds support at this level, it'll be off to the races. And the next level, Tim's crayon drawing allows us to get a price target. Basically, we're going to duplicate this price move a second time, which gets us up to this level, which coincidentally is the upper median line of our modified Schiff Andrews Pitchfork. What the heck do I know? Just a good old country boy from Texas. And so there you have it, folks. I've said it. I've made my official prediction by January of 2023. The price of gold will be at least $2,500 an ounce. Enjoy the rest of your day, the rest of your week. Talk to you soon.